Hello, welcome to the Real Estate Regroup Show. I am your host, LJ Walker, a real estate investor presenting information that will shift your thinking on how you can own a home or invest in one. Today's show, the topic is how to maximize your tax refund. First, one of the things that I like to do, and I encourage others to do, is to talk to your accountant or tax attorney. Don't always wait until it's time to do your taxes. You should actually have a conversation with them throughout the entire year. Basically, what you want to know is how you can minimize your taxes for the next upcoming year. And whenever there's any major event that occurs, you really should address your accountant or tax attorney. Let me give you an example. In Georgia, when I bought the properties there, they needed a gut rehab. About 2 weeks after I purchased it, someone offered to buy those properties from me. Well, I contacted the accountant right away, and he said to me that if I were to sell it right then and there, I would be hit with a 40% capital gains tax, which would eat away whatever I gained on that particular property. So that is why I encourage everyone to maintain a relationship with an accountant on the regular. If your accountant is busy and you can't reach them all the time, there are a number of accountants right here on Facebook that may be able to assist you. So you may want to look into that. The second thing you should consider is paying off your debt, particularly bills and credit cards. Lowering your bills and your credit card payments will improve your credit score. A higher credit score means that you pay lower interest rate when it comes to buying a home. You also are a little bit more flexible as far as what kind of loan you will be able to obtain. Yes, when you have bad credit, you can still get a loan, but your interest rate will be a lot higher, and the type of loan and the number of banks that will be willing to loan to you will be really slim, if none at all, depending on how bad your credit really is. Number 3, consider buying energy efficient appliances if you live in certain cities and states that offer a tax credit for you to do so. Now, I have bought secondhand appliances thinking that I was saving money, but in the end, after a few months, I had to replace them. So it's not worth it. It's better to go and get something new. And if it's energy efficient, you can, of course, always write that off on your taxes. Some utility companies will also offer you a credit towards your bill if you purchase an energy efficient appliance. So that's something else to consider as well. That's another added bonus, if you will. 4, if you are in the market for buying a home, you might want to consider buying a home in an opportunity zone. Opportunity zones, a lot of people I see, they mention that it is in certain cities. Actually, within those cities, it's in particular neighborhoods. My neighborhood actually qualifies for one. And when you do buy a home there, you get a tax credit as well. You should also let your accountant know that your home is located in an opportunity zone so that they can remember to apply that when they are doing your taxes. Hopefully, if you've already done so, you mentioned it to him. I believe if you did not, and they did not indicate that on the taxes, I believe that they can amend it, but they might charge you extra. However, if you have not bought a house yet, I would seriously consider looking into opportunity zones. All opportunity zones, by the way, are not in bad neighborhoods. Some of them are actually in, well, I wouldn't say affluent neighborhoods, but they are in middle class and upper middle class neighborhoods. In addition to that, I've noticed that some crowdfunding sites and some other companies are offering what is known as opportunity zone funds. Now, that would be more for people who they're not necessarily ready to buy a home as of yet, or they already own a home, but they want to take advantage of investing their money and seeing their money grow. Well, the benefit of putting your money in an opportunity zone fund is that you're not taxed the same way as if you were taxed in another type of mutual fund or ETF or REIT. You are only taxed, I believe it's 85% as opposed to 100%. The key is that you have to leave your money in those funds for 5 years. I recommend before you invest in these funds, do your due diligence and check out the company, particularly if it's a company that's not on a popular crowdfunding site. Just do your due diligence as far as who has set up the fund, what their reputation is, the company, and also the individual who's in charge of the company should be looked into. Number 5, there are actually some cities that will pay you to move. So again, if you are looking to buy a home, you might also want to consider using part of that tax refund money towards a down payment in purchasing a home in one of those cities. Now, mind you, many of these cities that are offering to pay you to move give you a tax incentive, which is normally, I believe, lasts 2 to 10 years, depending on which one you choose. And they also give you a significant amount of money towards your down payment. Baltimore, if I'm not mistaken, I believe it's $10,000 if you stay there for 2 years. You have to buy in a neighborhood that is blighted or on the edge of being blighted in order to qualify. For a full list of these cities, go to marketwatch.com and then do a search for 9 cities and states and countries that are willing to pay you to move, and you will get that information. Oh, and by the way, sorry, I forgot to mention the link for the Opportunity Zone. To find out if the neighborhood you're interested in is in an Opportunity Zone, you want to go to http://www.irs.gov. In the search bar, put in Opportunity Zone map, and it will take you to a link that will give you a map showing you where all the opportunity zones are. You want to then go in the upper right hand corner in the search bar and put in the zip code. Once you put in the zip code, it'll narrow it down and zoom in on the area in which you're interested in. Number 6, note that any improvements that you make to your home office, especially if you have a rental property, is tax deductible, and that would include landscaping. So you may want to take that refund and put it into one of those areas. That is, if you are already a homeowner. Number 7, if you are already a homeowner, you may want to also put that towards your mortgage. I noticed that by doing that, my refund was a lot larger. Number 8, this is something new that I just found out about. There are certain countries that have international tax agreements with the United States. Let me give you the website so that you can get a list of all the countries that have this. It is http://www.irs.gov/business/tax-states-income-treaties-a-2to-z. Here's what this means. If you own a business or you are in network marketing and you go to any of the countries that are listed there, and let's say you have a bag or a t-shirt or a hat that has the company logo on it, you are marketing. So therefore, you are doing business, even if you're not necessarily talking about business. But let's be real. A lot of times when you go away on vacation, even though this would not be considered a vacation, it would be considered a business trip. But when you go away on vacation, a lot of times you meet new people. One of the things they always ask you is, what do you do for a living? When they ask you that, you normally tell them, I do X, Y, Z. Now, if you have a job working for someone else, you cannot consider this a business trip. And it's, even though you are marketing for your company, it doesn't count. It only counts if you are a business owner or a network marketer. You can count that as marketing costs, from what I understand. And in addition to this, if you make a sale while you are there, you're taxed at a reduced rate, and on certain items, you are exempt from foreign taxes. So now I see why Robert Kiyosaki and Grant Cardone are trying to encourage people to be a network marketer, because everybody doesn't necessarily have an idea of going into business for themselves. However, just about everybody and anybody can sell something, and it's just a wonderful tax write-off. You can again speak to your tax attorney and your accountant for more information on that, for clarification and for verification. Number 9. You can also, when you're going out to eat to a restaurant, it can be considered a business meeting or strategic planning if you, as a business owner, or I guess this would also include network marketer, meet up with other business owners or network marketers, or if you are a business owner, your employees at a restaurant. You can actually deduct that from your taxes as well. Next, you can use the money towards your education. All business books, which also includes marketing, even if marketing is not your main form of business, seminars and expos are also tax deductible. If the seminar or expo is in another state or country, note that you can also deduct the cost of airfare and the cost of the hotel room. Again, speak with your tax attorney or your accountant, because there are certain guidelines in doing it. From what I heard one person mention was that when you go away, they only count the days in which the expo is there. But if you arrive like the day before the expo and then leave the day after, I believe I was told that those days don't necessarily count. I spoke with the accountant a while ago, and I don't remember exactly how that went. But definitely, you going to the expo, going to the seminar is deductible. I know that for sure. Next, you can put your money into an investment club. Facebook has a lot of wonderful investment clubs that you might want to look into that can teach you how to invest, how to grow your money. They can even break down to you what an opportunity zone is and help you choose an opportunity zone fund if you were interested in it. And not only that, some of the investment clubs also offer networking. This is how Erica Padmore and Wanda Fields, how we met. We were in Club Millie. Club Millie is now just a Facebook page, and the group is now the Black Billionaires Club. But basically, the person in charge, his name was Evan Jefferson, and he taught us how to invest our money in the stock market. He also encouraged other business owners within the group to present their businesses and services. He gave interviews. He also encouraged many of us to write books, and those who are already authors, we would have a Facebook Live interview showcasing our work. So that is also, by the way, if you're in an investment club like that, where you're actually networking in that way, that's marketing. So that is tax deductible. And especially if one of the members in the group buys your product, again, that is something that is a good use of the money that you have retained your tax refund on. Next, I would think about adding the money into a self-directed IRA or ESA or HSA. All three of these can hold real estate, and they hold them tax-free. If you needed to take money out, for example, out of a self-directed IRA, unfortunately, you have to wait until you are 65 or else you will be penalized. With an ESA, you can actually take the money out beforehand. With the ESA is not a retirement vehicle. Basically, you use that money for paying any educational expenses, uniforms, books, tuition. That's what the ESA is for, and you can pull that money out and it won't be taxed. And then lastly, the HSA, which again can also hold real estate, you would pull the money out from that to pay for any healthcare costs, and there is no tax on the money that you pull out of that for healthcare. Many people actually prefer the HSA over the self-directed IRA. Next, you can put the money in the bank for reserves. There are many banks out here now that are offering 2% and more return. I would look into that. However, 2% is still quite low. So if you want your money to grow a little bit more, then I would suggest that you invest in other things such as tax liens, tax deeds, mortgage notes, and municipal bonds. Many of you know I myself have created my own ETFs on a platform called Motif Investing. You can go to http://r.mt as in Tommy, F as in Frank, .io/AB as in boy, ID as in dog, N as in Nancy. So again, that's http:// r.mtf.io/ABIDN. And there you can invest for a minimum of $300 in any of the funds that you see there, or you can create your own fund, as a matter of fact. And when people invest in your fund, you get paid. So you can also, in a sense, go there and make money for free. Again, it's totally up to you. And in that particular platform, besides the funds that I created, there are other people there who have also created funds to help minimize the amount of taxes that you pay. And then lastly, another avenue that I found out about is there's something called the Tax Planning Estate Trust. It is something that you set up for your children, and that when you pass on, your kids can use that money tax-free. To find out more information about this, regarding this, I probably would go to a tax attorney for setting this up. And basically, you would put your property in that. Well, folks, I know that was a lot to digest. That's all I have for you tonight. Hopefully, the information will inspire you to reboot your mind, reset your focus, and make smart financial moves. Feel free to pass it along. Remember, each one, reach one, teach one. Bye for now. Have a good night.